We have a very busy week ahead of us. There are lots of macroeconomic data points due, including US consumer confidence on the 28th of April, UK consumer confidence on the 29th, and then manufacturing purchasing managers' indices and US non-farm payrolls on Friday the 1st of May. But the biggest item from a top-down perspective is likely to be the latest two-day meeting of the US Federal Reserve, which concludes on Thursday the 29th of April. Remember that the US Central Bank made two unscheduled interest rate announcements in March and cancelled its meeting in the middle of the month as it 1. Cut interest rates from 0.75 to 0.25%, 2. Increased its support for the US interbank lending or repo market, and 3. Relaunched its quantitative easing or QE program. Now QE4 started off as a $750 billion scheme, but quickly became $75 billion a day. That's now been shot back into just to $15 billion a day, still though a huge number. The net result is that the US interest rate stand at a record low, and the amount of assets on the Fed's balance sheet has soared by $2.2 trillion, or 53% since the end of February. That tidal wave of liquidity looks to be carrying US stocks higher. Students of history will, however, remember that the first round of QE that began in autumn 2008 had a similar effect, only for the S&P 500 to buckle in the face of weak economic data and corporate earnings reports, and it eventually only bottomed 5 months later. This Fed meeting will therefore be important as economists, investors and probably politicians judge the central bank's view of how its policies are working, how the economy is responding, and whether it feels that a change is needed to either withdraw or even ramp up the stimulus it's providing. On the corporate front, the first quarter reporting season in the US will remain in full swing. Reports from Caterpillar on the 28th, Microsoft, Facebook and Tesla on the 29th, Apple on the 30th, and oil majors ExxonMobil and Chevron on Friday the 1st of May should all prove informative. On this side of the pond, we're also due a number of trading statements and first quarter reports, plus some delayed sets of full year results. Corporate updates which could prove illuminating include the following. BP, builders merchant Travis Perkins and real estate investment trust Hammerson on Tuesday the 28th of April. Barclays, AstraZeneca, GlaxoSmithKline, Next, WPP, Whitbread and Persimmon on the 29th. Shell, Sainsbury and Lloyds on the 30th. And Royal Bank of Scotland on Friday the 1st of May. But for me, the company most capable of causing a fuss in the week ahead is another bank, HSBC. This is partly because it's the first of the big five banks to report its first quarter numbers on Tuesday the 28th of April, and partly because its operations straddle Asia, and especially Hong Kong and China, the US and the UK. As a result, the update could provide some insight into how the COVID-19 outbreak is affecting those economies. Now, HSBC shares have taken a hammering in the past 12 months, falling 38% at the time of recording. That compares with a 34% drop in the S&P 1200 Global Banks Index. It's undeniably a tough time to be a bank. Interest rates are near zero, the global economy looks set to take a big hit, which could mean sour loans. Lenders are also clearly going to be expected by governments to offer help businesses and in the form of new facilities or existing ones. That could mean more sour loans. Oh, and the Prudential Regulatory Authority has told the British banks to stop paying dividends and cancel share buyback programmes, so they've more capital on the balance sheets and can better withstand, yes, you guessed it, more loans going bad. This means that the first number that analysts will look for will be provisions for bad debts and asset impairments, especially as the big four US Main Street banks, Bank of America, Citi, JP Morgan and Wells Fargo, took $24 billion of such provisions between them in Q1 2020. That was the highest quarterly total for 10 years, when they were just staggering out of the credit crisis in early 2010. In the first quarter of last year, by the way, HSBC's loss and impairment provisions came to $585 million, although note how that figure has been trending up since early 2018, to suggest the global economy had already been slowing sometime before the viral outbreak. After that, attention will switch to the growth in loans and deposits. The American banks showed increases in both, but with deposits growing much faster. It'll be interesting to see if HSBC's clients also made a dash for cash. The next key figure is the net interest margin. This has been under pressure thanks to low interest rates, hot competition and modest growth, although at least yield curves have steepened a little bit and the interest rate spread on corporate loans over government ones has increased a bit. In Q4, however, HSBC's net interest margin sank to just 1.58%. Add in any conduct or litigation costs and restructuring charges, and you then come to the headline pre-tax profit number. The current consensus forecast is for a broadly flat profits at $13.6 billion across the whole of 2020, helped by the absence of a $7.5 billion goodwill write-down in the fourth quarter of last year. Last year's Q1 pre-tax profit, by the way, for a benchmark, was $6.2 billion. Finally, to finish, we'd normally look at the dividend. For every year since 2015, HSBC has paid 10 US cents in quarters 1, 2 and 3, and 21 cents in Q4. Not this year. After pressure from the UK's regulators, the bank has said it will pay no dividends in 2020 calendar, although that does mean it could declare a dividend for the fourth quarter of 2020 alongside its final results in calendar 2021, so watch that space. Thank you for listening. I hope you and your families are all keeping well during these difficult times, and I look forward to talking to you again next week.